Gold is trending up as Fed is set to raise interest rates. Gold has been going up day after day. There are many who believe that when interest rates rise, gold gets weaker. The same relationship is thought to be true of the equities market. A strong equities market should mean weaker gold. The truth is, gold can rise with interest rates and with the equities market. If these inverse relationships are true, then the Fed raising interest rates should be bad for gold. So why is gold gaining? A better question, why are Wall Street asset managers holding on to their gold positions? The thought is that the Fed will not be able to raise rates out of negative territory. So what does that mean? When we look at interest rates, we have to account for inflation. Real rates equal the nominal interest rates minus inflation. That means to get out of negative rates, the Fed would have to raise rates beyond what anybody thinks they will. Most analysts believe that we will be in negative rates for a long time. This could be very good for gold. What's important to remember beyond economic fundamentals is asset prices go up or down by the inflows and outflows of money. Simply put, more buyers than sellers usually means prices go up. More sellers than buyers usually means prices go down. Why would fund managers or consumers move money out of gold into interest-bearing accounts if money would lose value? Because the interest rate is lower than the inflation rate, meaning the interest rate is negative. How negative? According to Bankrate.com, the best a saver can do currently on a 5-year certificate of deposit is 1.3%. Now, subtract the whopping 7.5% inflation rate from the 1.3%, and our retirement saver is currently earning, in terms of real rate, negative 6.2%. In summary, the Fed raising rates is not moving money out of gold. Money is actually moving towards gold if you look at money flow and asset prices. Typically, regardless of real rates, when the Fed tightens their balance sheet and raises rates, that means less money flow into the equities market. Typically, in those periods, we see equities come down, as we have seen over the last several weeks, while markets prepare for higher rates. This means money is moving into gold as the market gets set for the Fed raising rates. If you happen to own gold already, you may interpret negative rates as a sign to increase your allocation. And if you don't own gold, you might see this as the right time to make your first purchase. The best way to make these decisions is to try to learn as much as you can about what's happening in the economy right now. Too many retirement savers get stuck in old adages, like rising rates is bad for gold, or a 60-40 split between bonds and equities will keep you safe. One of my favorites is, don't worry, you'll be okay in the long run. To learn more, we invite you to participate in a free web conference with our education team. Sign up today at AugustaPreciousMetals.com or by using the link in the description of this video.
Hey guys, Joe Montana here with my man Devlin Steele. He and his team at Augusta Precious Metals are constantly putting out new information to keep you ahead of the game. Click subscribe now and hit the notification bell to stay up to date. You'll be glad you did.